Hey everyone, my name's Jeff. I'm the head of marketing at A2X, which is e-commerce accounting automation software for the world's top Shopify, Amazon, eBay, Etsy, Walmart, and multi-channel sellers, as well as their accounting partners. And speaking of accounting partners, I'm joined today by Sam Hill, who is the founder and CEO of Ecom CFO. Ecom CFO is one of A2X's top partners. They provide accounting and CFO services to some incredibly impressive seven, eight, and nine-figure brands. If there's anyone that knows about how to get accurate financials for e-commerce brands, as well as how to make sense of the information, it's the Ecom CFO team. So super excited to have Sam here with us today. And the reason we have Sam here with us today is the Ecom CFO team just put together an incredible 2025 profit and loss statement benchmark report, which effectively surveys tons of private and publicly traded e-commerce brands. And the idea is to give you a good understanding of how you're performing comparatively to peers, whether you're outperforming, whether you're underperforming. And the report also provides some incredible insights on what you can do about building a more profitable brand in 2025. So, Sam, thank you so much for joining us here today. And I'm just going to get into it and
Let's
ask
do
a
it.
question. What was the motivation behind putting together this amazing asset?
Oh my goodness, this is something that, and thank you for having me, Jeff. This is something that we've been wanting to put together for a couple of years now. And we had published little snippets of different benchmark reports on my LinkedIn, but wanted to put something together much more comprehensive. I think that a lot of the content related to anything resembling benchmarks in our industry is absolute garbage or just completely non-existent. And I've been saying that for a long time. And then I went into ChatGPT and tried to search for other benchmarks for specifically private D2C companies. And we are the only bit of information that pops up or source of information that pops up. So I can confirm that this was true. And all of our clients would ask us all the time, hey, what else are you seeing in the market? What else are you seeing in the market? And am I doing good? Am I doing bad? How do all of these different benchmarks compare to our peers? And so we just decided to aggregate all this data together, and not only from private companies, but also from public companies.
Mm.
And this is not a, oh my gosh, if I'm not performing at this level or meeting the 95th percentile of this benchmark, then the world is on fire. Um, in the report, we say that you should really be triangulating against three different points of contact. Number one is your own performance. That's number one. Number two is private companies. And number three, which I think is underrated, is public companies as well. There's so much information to glean from the Yetis of the world, from the Hims of the world, from the Elf Beauties of the world. And all of that data is publicly available because it has to be. And there's just a treasure trove of information from those companies as well. So long-winded answer to your question, but that's a lot of the motivation that went into this report.
Okay, Sam, before we get into some of the metrics as well as the benchmarks, probably helpful to frame your view on how e-commerce sellers can get maximum value from the report.
So if I'm an e-commerce owner, uh, number one, I need to actually read and understand all of the definitions and metrics that are in the report. And if I don't, that might be a signal where I need to quickly chat GPT something and make sure that or watch a YouTube video on it and make sure that I understand what all the mechanics. And then secondly, once I'm confident that I understand them, number two, comparing them to my own performance.
Mm.
And if I find myself struggling to compare to my own performance because I can't find the number or it's buried somewhere, then that may lead me to make a new decision of, oh, okay, well, my underlying data is bad, so I need help figuring that out. Because the all of the reporting and the benchmarks are useless if I don't have anything to compare them to. So assuming all of that has been done, then awesome, fantastic. Then use them to sanity check against your own budget. Because one of the most important things that we call it in the report is, hey, you should have a budget, period. And it doesn't matter who's doing it, if you're doing it yourself, if you're doing it with your internal controller, CFO, or if you're doing it with a firm like ours. It's, what do I do with all this information? So if I've worked with my marketing team, my internal team, and we say that we're going to grow 200% next year, and I look at the benchmark report and see that the 95th percentile was growing 100% and not 200%, that may cause me to press pause and say, okay,
Mhm.
maybe I do believe that I can grow 200%, but should I plan on something less? Because that's going to drive a lot of other decision making, like inventory planning, hiring, etc. And do I want to incur all of that additional risk, knowing that that is well beyond what any other company did last year? Not saying that there's not examples of people growing 2, 4, 500% out there. But just sanity checking, and you that might cause you to make a new decision.
Amazing. So for this next part of the video, I'd highly recommend actually downloading the report. It's available in the description below and following along. In this video, we're going to double click on, I think, four key metrics. One is revenue growth, two is gross margin, three is contribution margin, and four is EBITDA. Sam is going to provide a definition of each of these metrics. We're then going to talk about some of the performance that we saw in 2024, as well as some of the key takeaways. So, Sam, starting with revenue growth, I don't think that this needs much time to drill into the definition, but do you want to give it a shot?
Yeah, revenue growth is simply, we took a 12-month period as our start. We took the next 12-month period and we determined what percentage growth happened comparing those two periods. Plain and simple. One important note, Jeff, that I think you're actually asking about is this gross sales or is this net sales? Does it include sales tax, et cetera, et cetera? So our revenue growth is net revenue. So it's net of discounts, net of refunds and returns, sales tax completely excluded.
Awesome. One of the things that we saw in the report, which is kind of this is one number that was consistent across smaller and larger sellers, so those doing below 50 million in annual revenue and those doing above, was that we actually saw growth averaging around 27% overall, um, roughly 24% when we remove higher and lower outliers. What factors do you think contributed to that, I would argue, relatively strong performance in 2024?
Yeah. So keep in mind that this is the average. So some businesses performed much better,
Yep.
some businesses performed much worse. So this is the average. Across the board, I think we saw a lot of price increases. That's a big contributor. Another contributor is just simply more people are buying stuff online. So
Mm,
let's not forget that there is a background growth of people moving from physical to online sales, and that's still happening. I mean, Amazon and Shopify, when they report their larger growth numbers, guess what? It's always positive, or at least it has been for a very long time. So we do have to keep in mind that there's probably, I don't know what the exact number is, but my guess is there's probably 5 to 8% of just baked in organic growth where people are buying more stuff online, period. So we
got
have
it. I
that.
mean, it feels like people flog themselves quite a bit because we're not experiencing growth from the COVID era, but e-commerce as a percentage of retail growing totally makes sense in your definition.
Yeah, absolutely. So we have the background growth, we have price increases, we have some companies being really successful in new product launches or new sales channel launches like TikTok. And one of the double clicks that we broke out was wholesale. We saw wholesale as a percentage of revenue definitely increase as businesses looked for more places to sell their product and not just default to giving Meta and Google more money, but how can I reach smaller boutiques or salons or country clubs or these other B2B opportunities that a lot of businesses just didn't pay enough attention to or a lot of attention to previously.
It's funny too. I think when we look at Shopify, they're expanding their B2B functionality quite a bit. So this isn't just true in the data that you're presenting, but it's true in how a lot of these platforms are actually trying to enable sellers. Really interesting. So just to recap, price increases, um, just e-commerce growth as a percentage of retail, channel expansion. So we're talking TikTok, we're talking wholesale, and then obviously launching new products. Awesome. Okay, so thanks for the insights on revenue growth, Sam. Let's go into another really important financial metric. I'd love, if possible, if you could actually start by providing us with a definition of gross margin so that we can align the audience.
Yeah, so we define gross margin as net revenue minus all of the product costs. If you're a manufacturer, this may also include your labor to produce or assemble the product. And we also include freight in to gross margin. So that is the cost associated from getting it from your supplier to either your warehouse or 3PL, et cetera. What is not included is merchant fees,
Hmm.
Amazon's commissions and fees, ads, pick, pack, ship to the end customer, etc. And again, we don't make these definitions up. These are fairly standard accounting metrics. And this is another reason why I love public company data is not just in the annual reports themselves. They report on their financials and their performance. They also state the definitions. So there's a lot of wonderful information in the on pages 50, 60, and 70 in all of these public company reports because they tell you exactly what's included and what's not included. So this is not something that we're making up. We're taking an industry standard.
So one piece of information from the report that was actually quite interesting is that gross margin was about even year over year, dropping probably 2% for brands under 10 million in revenue, and then growing roughly 7% for those over 50 million in revenue. Was this piece of data surprising to you?
Um, Gross margin being roughly flat, I think everybody would have expected gross margins to be down because inflation, product costs go up. Freight's been meh depending on the month. I mean, we had a lot of like conflict throughout the world, which made supply chain more expensive. So I think if you didn't tell me anything else, if you didn't show me the data, I would have expected gross margins to actually be down, but they've been up. Again, that points to price increases.
Mm.
I think also our clients started to discount more and manage their refund and return policy more. And we also saw some of our clients step into their reverse logistics programs and actually accept product back into their warehouse, whereas they would have scrapped it otherwise. Because it's as the price of the product increases, as the cost of scrapping that product increases, the inflection point is turning over to now it's valuable to me to actually take that product back in an inventory, refurbish it, clean it, inspect it, et cetera, and then put it back on the shelf for the next time.
In the report, you also discuss the importance of having a SKU rationalization program. Can you share more about this and how it impacts gross margin for companies of all sizes?
The SKU route rationalization, I think this is one of the biggest opportunities that's not really discussed. Um, all this means is being very careful and intentional about which SKUs are on your website, which SKUs are on Amazon, which SKUs are across all of your sales channels, understanding what the margin profile is, and then being diligent enough to cut them when those margins don't make sense anymore. And the the psychology is difficult, and I completely understand this because most of our clients are bootstrap founders and they created these products themselves in a lot of cases. So if you create something that yourself, you're more likely to value it highly and you're less likely to be as diligent and cut it and move on. And so it's part psychological, at a part arithmetic. But you just have to be diligent enough to have a process in place to evaluate those on a periodic basis and then make a decision.
I think that's really interesting. Like to me, it's quite analogous with owning a home and then selling the home. Like one of the reasons you work with a real estate agent is to help you set expectations because the people that are selling the house typically have a significantly higher view of the value of said house. People buying significantly lower. So, everything that you just described in terms of building your own product and having kind of an emotional connection to it makes a ton of sense. All right, Sam, let's get into the next metric, which many accountants and bookkeepers would consider the holy grail for an e-commerce business, which is contribution margin. To get us started, again, do you mind providing a definition for contribution margin for us, please?
Sure, absolutely. So we define contribution margin as gross profit that we just talked about, minus all of the variable selling costs, including merchant fees, including ads, including pick, pack, ship. This may include a couple other fees or things like affiliate commissions, or if you have an internal sales team, it may also include their commissions as well. And we can have an hour-long debate about it. But in general, contribution margin includes variable selling costs.
This is one of the areas in the report, I think, where you saw the biggest contrast between small and large sellers. Contribution was down overall, roughly 2%, but the pain wasn't felt equally. Like brands under 50 million saw a 3 to 16% drop, while those over 50 million saw a 28% lift. Was this surprising to you at all? Any way that you can explain the delta?
We think that we're special in e-commerce. And if you read any history, business history in particular, I recently read House of Morgan, which is Rob Chernow's book, which is the history of JP Morgan, the entity, not the person.
Hmm.
And he also has a phenomenal book on John D. Rockefeller called Titan, and it's the history of Standard Oil effectively. And one of the takeaways from both of those books, two very different businesses, is the rich get richer. And
Hmm.
if you're at scale, it's easier to continue to scale. And that's effectively what we're seeing in the difference between the less than $10 million businesses, the 10 to 50, and the 50 plus. That there are economies of scale. And if you, for example, if you're producing a lot of content, that content can go further. You can have more leverage on Meta, Google, etc. You can afford to launch and test on additional channels, and it doesn't hurt you as much as it does a smaller brand if those tests don't go well. So that's a lot of the higher level reasoning in the disparity.
You also have more existing customers that you can remarket to and sell additional products to as well,
Absolutely.
which makes a ton of sense. One of the things that I thought was really interesting in the report was your categorization of contribution margin. You actually called it a fragmented mythical metric. I wanted to ask, what did you mean by that?
We all know what revenue is. Again, we all know what gross margin is. And going back to the public companies, um, you will not find in any public company annual report a mention of contribution margin because
Hmm.
it is not a required metric in accounting on a financial statement. But it's incredibly important for companies in our industry. So it's mythical in that it's not defined anywhere in most accounting textbooks or any public company 10Ks, or you won't hear them talk about it on their earnings call. And it's fragmented because it's used in a lot of different ways, and it can have a lot of different meanings. You can look at contribution margin by channel. You can look at contribution margin by SKU. You can look at contribution margin by geography. You can look at contribution margin by customer type, whether it's a new or returning customer. And each one of those has kind of its own unique definition and what you would include or exclude. So we just have to be very careful when we're talking to clients when we say contribution margin and we're talking about a particular decision. What are we actually talking about and creating that definition for that almost specific conversation and that specific use case. So that's why we call it, or I call it, fragmented and mythical.
Awesome. I mean, so Sam, we talked about how this is the one metric where there is a massive delta. The rich get richer and the poor get poorer. If you are a smaller seller, one that might have seen a 3 to 16% drop in contribution margin, we talked about kind of tactical tips on what you could recommend brands do if this is the situation in which they find themselves on this metric. What are, or at least how would you approach the problem?
Mm. So I would approach the problem in taking a step back uh, and ask myself, what do I need to believe to be true to accomplish my objective? So my recommendation or my advice depends on if your EBITDA target is break even, if it's 5%, if it's 10%, and then what are the fixed costs that I need to have to run the business or grow the business? And so therefore, what does my contribution margin need to be to achieve those things? Because again, it just varies so dramatically if you've never been profitable or you haven't been profitable in the last 2 years and you're trying to get to break even. My advice for your contribution margin target percentage, et cetera, would be a lot different than if you're trying to go from 5 to 10%. So I think just kind of reframing the problem and more thinking more holistically, because at the end of the day, contribution margin is an indicator, but that doesn't mean that that's more money going into your pocket. We have to look at the whole P&L and L and the whole um, financial statements first. So that's how I would approach the problem.
Also speaks to the importance of working with an accounting professional or an outsourced CFO team and the value that that can provide to your business. Because to your point, like a lot of these metrics are lagging indicators, but to understand what their target should be and how to actually make a dent in them is very contextual and dependent on the business. But you need the accurate information to be able to make informed decisions, and you need the insights and um, the strategy and the consultative approach from somebody that actually knows what they're doing, like the ecom CFO team. I'm not saying this to pump your tires. This is not meant to be a plug. Uh, but it just like these metrics specifically, what to do about them, speak so clearly to the need to work with an accounting team like ecom CFO. You don't have to comment on that. I'm just making a statement.
Well, no, I mean, so often you're right. And I think I'm probably jumping ahead in that the first part is just identifying what your contribution margin is, period, and what that means for you. What are you including or excluding into that metric? And can you rely on your accounting system or worst case, a Google Sheet or whatever your source of truth of data is to actually define what contribution margin is for a particular period in time, whether it's a month, a week, a year, whatever that is, and then work from there. But so many founders can't even tell you what their contribution margin is, let alone what it should be or how it relates to the entire financials.
100% makes total sense. So let's get into the last metric that I wanted to chat about before I'll kind of open the floor to you to call out anything that you might have found interesting. But that's EBITDA. Do you mind starting off by providing a definition, and then we can talk a little bit about the what we saw in the report?
Yep. Quick definition of EBITDA is, I'll just read out the acronym: earnings before interest, taxes, depreciation, amortization. All it really means is operating profit for the vast majority of our clients who don't have fixed assets. So therefore they don't have depreciation. EBITDA and net income are the same, with the exception of any financing costs or the interest that they're paying on their SBA loan or their line of credit or any other alternative lender that they've gotten financing from. It's really the only difference.
Nice. And this is another metric that the report kind of highlights where the rich get richer. EBITDA dropped, or EBITDA, potato, dropped dramatically among smaller brands, primarily due to fixed costs, while rising roughly 61% for those over 50 million. I already know what the answer is going to be here, but like, was that surprising to you at all?
No, it wasn't surprising, but it was it was just sad, honestly, to me, because we
Yeah.
watched a lot of businesses not cut costs fast enough or deep enough throughout the year, hoping that Q4 or things were going to turn around, and then that not happening, and then them having to make harder decisions now and making even deeper cuts. So this is some of the hardest. I think this is one of the hardest things to do in business is cutting costs, because you're signaling to the rest of your team and to yourself sometimes that things aren't going great, or it's going to signal, or you think it's going to signal bad morale, or you think it's going to signal lower morale to your team. And especially letting people go is very difficult. But simply put, you can either make easier decisions now or you can make harder decisions in the future, um, because the problem is only going to continue to compound. And I think we saw a lot of businesses ignore the severity of the problem in the short term, not making those cuts, and then again now having to make a lot harder decisions.
Yeah. Having the insights to know in time, I think is critical. Kind of goes to our last point about the importance of working with accounting and finance professionals. Because if you don't have that visibility and you don't necessarily know that you need to make those decisions in the short term, that the eventual outcome, unless you're saved by a new channel or a new product, is that you will have to make those tough decisions and those cuts.
I'm
One,
sorry, one more point on this,
yeah, go
Jeff,
ahead.
too, is going back to, again, it doesn't matter if it's us or anyone else, but having a budget, because if you have a budget and then you're pulling the actuals every month and you're comparing it to that budget, and you say, oh, well, I'm spending $25,000 more on content than I expected. Where is that going to come from? You have that ability to make better, more informed decisions on a monthly basis than if you have no budget and you say, oh, well, my photo shoot just went over $5,000. No big deal. Oh, I'm just going to try this new app for a couple months and we'll see how it goes. Oh, that new hire took more time, so I had to incur more LinkedIn ads or more
Mm.
recruiter costs or whatever. And all these things just start to stack up, stack up, stack up. And if you're not monitoring it, then it can get out of control really quickly. So just another plus one for having a budget and managing to it.
Yeah, 100%. Having a budget though and being forward looking um, is dependent on having accurate historical information and data. So I think, one of the lessons here is if you're not working with an e-commerce accounting professional, I would highly recommend doing so that you can have that look behind and but also the look ahead that Sam is mentioning, and also the guidance on, how to understand how to take action against many of the metrics that you see here. Hey Sam, one of your conclusions at the end of the report is that, and I feel like everyone watching this is feeling this, but it's this idea that everyone is coming for your margin. Yeah, I'm going to ask you what do you mean by this, and I'm going to play a little dumb here, but I do want to know what are you thinking here?
Yeah. If I'm an owner and I'm just going to close my eyes and envision my P&L from top to bottom, we can think of different people. I use the term everyone, but it's people, apps, suppliers, vendors. Everyone is coming for your
Fees.
margin from top down, starting with customers. Customers
Mhm.
want deeper discounts. They want free shipping. They want better return policies. They want things shipped to them faster. They want um more like gifts included. Cost of goods sold, your supplier costs are going up. The shipping costs are going up both in and out to customers, going down to the variable costs. All of these apps are continuing to raise prices. Your Again, your shipping costs are going up. Um, your merchants may be more strict on their chargeback policy or whatever it is. And then going down to the fixed costs, people want to get paid more. People want bonuses. They want incentive programs. They want 401k matches. So in every single instance of your P&L, there's somebody or something coming for your margin. And if you don't protect it and you don't actively manage it, you're just going to get run over and then you're going to wake up with no profit and wonder where all your money went. And so uh, I hate to like seem as negative here, but it's really the truth. And if you're not actively managing it, bad things are going to happen, because I see it every single month.
100%. There's like a viral tweet from Sean Frank, CEO of Ridge, and he was saying that he was talking to a brand owner who is doing nine figures in annual revenue, but pulling, I think it was like $100,000 from the business. And just kind of the comments and the thread about how this is significantly more common than people realize. E-commerce is a traditionally lower margin business, which is why you need to be on top of it. Like you just need to be on top of it. And I think that was my biggest takeaway from the report, and probably going to be the biggest takeaway for many of the people that are reading it or watching this video. Um, Sam, was there
Yeah,
anything else that you'd want people to take away from the information that's provided in this asset?
the biggest takeaway is one, read it. That would be amazing. Two, if you want to put it in ChatGPT and summarize it, or ask questions of it, then that's, the second best. The third best is if you have a coach, mentor, advisor, outsourced CFO, controller, or even some bookkeepers who are more competent in operating on a higher level and helping you with budgets and forecasts and cost control and stuff, give it to them. Let them read it and ask how this applies to your company and how you can make this work better for you. And then the second biggest thing that I've already said 14 times is create a budget, please. And even if you don't take the extra step in monitoring it or comparing it to actuals every month, just the fact that you've built the budget and not just a revenue projection, but going down line item by line item, that will give you more clarity and I think help you make better decisions and ultimately make you more profitable.
Amazing. Well, Sam, I just want to thank you so much for joining us today and for providing us with your thoughts and your expertise. Again, the link for the benchmark report is in the description below. If you don't have a coach or an e-commerce accounting professional supporting your business and you'd like to connect with Sam and team, highly recommend going to ecomcfo.co. Again, that is ecomcfo.co. Sam, thanks again so much for joining us, and I hope you have a great day.
Awesome. Thank you.